Hi, this is Sam and welcome to this week's market commentary. U.S. stocks ended Wednesday on a down note. The Dow Jones Industrial Index fell 206 points to 15,112. S&P 500 shed 23 points to 1628, while Nasdaq fell 39 points to finish at 3443. The major averages retreated into the close after the release of Fed policy statement indicated that the central bank will maintain its bond buying program at $85 billion a month. The market extended its decline as Chairman Bernanke suggested that the Fed may start to taper purchases later this year. All 10 sectors in the S&P 500 finished lower on Wednesday's session, with telecom being the worst performing group. Treasuries finished firmly in negative territory. The benchmark 10-year Treasury yield jumped by 15 basis points to 2.33%, the highest since March 2012. Gold futures lost 1.3% to $1348 an ounce, erasing an earlier 0.7% gain. Oil slipped 0.6% to 97.86 a barrel in extended trading. The Federal Open Market Committee, after a two-day meeting, confirmed that the risks to the economic outlook and the labor market have diminished, if not eradicated, and that it is prepared to reduce or increase the pace of bond purchases depending on the outlook for jobs and inflation. The U.S. unemployment rate will fall to 6.5% to 6.8% by the end of 2014, according to Fed officials' estimation, possibly reaching the central bank's stated threshold to raise the benchmark lending rate. The FOMC said the rate will remain in a range of 0 to 0.25% so long as unemployment remains above 6.5% and the outlook for inflation is no higher than 2.5%. The nation's jobless rate in May was 7.6%. The pace of its bond purchases currently at $85 billion a month will also be influenced by economic data. European stocks sank the most in more than 18 months after the Fed announced the bank may end bond purchases next year if the economy strengthens in line with forecasts. The Stoxx Europe 600 index plunged 3% to close at 283, the biggest decline since November 2011. The benchmark measure has declined 8.7% since May 22. When Bernanke indicated the central bank could pair stimulus measures as the economy grows. Asian stocks on Thursday slumped the most in almost 2 years amid concerns of credit crunch in China is worsening and the Federal Reserve will reduce stimulus should the U.S. economy continue to improve. The MSCI Asia Pacific Index dropped 4.1% to 127 points, heading for the biggest loss since September 2011. Hong Kong's Hang Seng Index fell by more than 2.8%. Japan's Topix Index slipped 1.3%, while the Nikkei 225 stock average decreased by 1.7%. South Korea's Kospi Index declined 2%, while Taiwan's TAIEX Index slid 1.4%. And Australia's ASX 200 Index dropped 2.1%. The pullback by both the U.S. indices overnight and the Nikkei Index dented local sentiments within Singapore as well. STI fell by more than 2.51% to close at 31.33 on Thursday. While clearly investors are still very cautious about the market outlook, and with today's tone of steep decline, we could expect the index to go through correction for weeks ahead while still maintaining an uptrend. Meanwhile, the next support base lies at the 3100 key trough, while on the upside 3200 remains the subsequent key hurdle to overcome. Currently, all these market indices are available under our CFD indices list. Plus, many more benchmarks based on different strategies are available via ETFs for you to trade both long and short with Phillip. This is all for today, and hope to see you soon with another round of market commentary. Thanks for watching.